Hi, my name is John Stevenson, the Guaranteed Retirement Guy. Today we're going to be talking about how to increase your savings with minimal risk. Okay, so there's a lot of things you can do, and some of these you probably already know. Okay, we've got bonds, we've got high yield savings accounts, and there's things we can do that will increase what we already have without subjecting it to market risk. Okay, and I'm going to talk to you about certain types of annuity contracts that will also do this for you, and they're quite effective. Okay, they protect you 100% against any market risk, and they have the potential to have a lot of growth. And some of them have guaranteed growth, some of them have potential, and I'm going to show both. Okay, but annuity contracts are very effective for safe money strategies. Okay, there are some that are not so great. Some of the variable products will have high fees. Some products will have fees, whether they're variable or not. And there are some great benefits for some of those fees, sometimes not. Okay, so you can get these contracts without fees. But you have to remember they are contracts. Okay, so when you put money into this and you're looking to just save it and you want to increase it and protect it, you have to remember that it is partially locked up. Okay, it's subject to surrender charges if you were to take all of it out. They usually will allow you up to 10% free withdrawal. So whenever you purchase an annuity, you want to make sure you have savings outside of that so that if you have emergencies, you can dive into that. Okay, so that's important. So if you have that set up and you're just looking for some way to protect your money, grow your savings, and be able to have that risk either minimized or completely erased, then I highly recommend looking at some of the fixed annuity options as well as fixed index. And if you set it up right, you do it with the right company, do it with the right strategy, you can do very, very well. Okay. A lot of times people will badmouth these because maybe they were sold the wrong product, or they just had advisors that sell them something that, and they were showing them these huge illustrations that looked great. But the problem is those indexes were new, or they, were out like 3 or 4 years, like until you actually get your first credit. Like a lot of those I do not like. So I'm going to show you the best ones. Okay, I'm going to share my screen. So first we're going to look at indexed annuities. And you might be thinking, well, how can I be protected? How can I have minimal risk if I'm, attached to an index, right? Well, if you understand anything about options or call options, when you purchase them, you have the ability to exercise them if that particular index rises in value. And if it does, you can exercise that option, which will allow you, it has a strike price that's much lower than what the current value is of the index. And so the strike price allows you to buy it at a lower price and automatically sell it at the higher current price and take the profit. Okay, this is what insurance companies do. They will purchase call options, and sometimes they will spend billions. I mean, even maybe tens of billions of dollars for these call options. And they'll make a lot of money off of them. The nice thing about these options is if the market goes down, you just don't exercise the option, okay? Because you were never in the market. So it allows you to have growth and protection, okay? You're never in the market, so you don't actually have any losses when the market drops because you were never in it. And at the same time, when the market goes up, you're able to get some of that growth. I say some of it because the insurance companies spend a lot of money on these options. So they're not giving you all the growth, they're capping it, okay? And that's fine because when you have down years, you're not participating in any of the losses. And the insurance company, they're not experiencing market losses, but they're experiencing a loss because they just spent billions of dollars in options contracts that they could not exercise. Okay. So that's why they will limit the amount that you make on the good years because they have to be able to cover the cost of their options, especially during the down years. Okay. So just want to explain that a little bit so you can kind of see how these work. But they're still very, very effective. And so the way they limit your earnings is either by a cap. A cap is just simply capping the amount, the highest amount that you can get. So if the cap's 8%, that's the highest you can get out of that index. Okay. So if the S&P does 12, you're going to get 8. Okay, every time. That's just how it is. But sometimes they won't give you a cap. They'll just give you a participation rate. So if it's 90%, you're going to get 90% of whatever it earns. So if it does 20%, you're going to get 18, or you're going to get 16%, right? So S&P does 20%. Actually, if it's 90%, you'll actually will get 18%. But if it's, let's say it's an 80% participation rate, then you only get 16% of that. See how that works? And you'll notice on my screen, there are some of these that will have a participation rate of 90 plus a spread of 3. What does that mean? Well, it means if the S&P does 20% during that period, during the indexing period, because again, they are measuring it from the issue date to the anniversary date. So that also goes into play. So let's say it's February 1st to February 1st the next year. That is what they are measuring, that period, okay? Whatever the S&P was at that time and whatever it is at the end of that 12-month period. That is what they are measuring, okay? And so they will give you whatever that earns subject to either the cap or the participation or a mix, right? Sometimes they have a mix of all of that. But you'll notice with this top one, it says participation rate of 90% and a spread of 3. So what they're doing is, let's say the S&P does go up during that period, 20%, okay? Well, your participation is 90, okay? So you've got 18%, but they got a spread of 3%. So your actual credit to your account is 15%. Now, let's say the market drops 20% the year after that. Your account balance stays exactly where it is. It retains all of its earnings. Because remember, you're not in the market, so you're not going to lose anything. That's the nice thing about indexed annuities. When the market crashed in 2001 and when it crashed in 2008, people that held these contracts, their values stayed the same. It did not go down because they were never in the market. And then when the market started rising, they immediately were able to start from where they were, not down here, but up here where their account balance was, and continue to rise. So that's what's nice about indexed annuity contracts. Okay, so that's what you're looking at here. So you can see all these different ones. You can see the top ones with security benefit. You see the name of the company here. You see different participation rates, different spreads, and you can see what the 10-year average, what the 15, and what the 20-year average is. And I'm doing with this with the S&P 500 only. You notice I am actually filtering out everything else except the S&P 500. Okay, there's a lot of indexes. You see here? There's tons of them. Tons. Hundreds of indexes. Okay, but a lot of these indexes are really, really fancy, and they have only been around for a year or two, and which means all the results that you see are back tested. So you have to make sure you're dealing with an index that's been around for a long time. Okay, that's really, really important. Otherwise, you got someone that's going to basically blow smoke, try to sell you something and earn a commission. Okay, what we want to do is we want to get you as much growth as possible without losing any money. Okay. We don't want to have risk involved. Okay. So that's what the purpose of this video is to make sure that you can grow your savings with minimal risk. Okay. All right. So let's look at this and we'll say, well, what does this look like? Security benefit. And we'll just kind of look at, you can see the guaranteed values is as if the index, the S&P does nothing. Your account value stays the same. Okay, that's pretty straightforward. Go to hypothetical. Wow, you can see some pretty big results because we've had a pretty good last decade. In fact, the last few decades have been great. So if it repeats exactly the same, and this is a big and, if the participation rate and or the spread remain the same, then you can see how your account value will grow. It's pretty substantial. Obviously, over 20 years, it can grow to $570,000. Okay, not bad from $100,000. And it's protected against market risk. So during the down years, you didn't lose a dime. That's nice, okay? So it's a good growth product. You have to remember though, participation rates, cap rates, spreads change because the cost of options change. Because of that, at the end of each crediting period, the insurance company can change these, okay? And this can adversely affect your illustrations. That's why guys will illustrate this and not tell you about what could happen later because they want their commissions. I'm not gonna do that, okay? So what I do is when you're looking at these and you're thinking, well, John, which one do I pick? I'm going to show you, well, here are the best companies that I know personally keep their renewal rates high, okay? So we'll look at that. One of these is Life of the Southwest. They're owned by National Life Group. It's been around for 175 years, okay? Pretty good. The cap is 14%. Wow, that's huge. But they're charging you a 1% fee for it. You don't have to pay the fee if you don't want to. If you don't pay the fee, the cap is lower. So they're charging you to take more of the cut, okay? More of the cut of the profits from their options contracts, okay? You're kind of sharing in the cost of what it's costing them to get these options, okay? So I don't think there's anything wrong with paying that account fee as long as you're getting something for it. And it's also nice that that if you do it, the market goes up. And no one knows when the market's going up, but if you feel good about it and things are going well, then there's nothing wrong with paying the fee because you'll most likely benefit a lot more than without it, okay? So there are ones without fees. Let's see here. I'm just seeing if there's, because I know this company quite well. Life of the Southwest, even without fees, they keep their rates pretty high. I want to say it's like 11%. I'm not seeing it on this screen, but But if you want to meet, we'll talk about it. Life of the Southwest is one of the best growth products, in my opinion, when it comes to the S&P 500 because their rates, their caps are high. Okay, they're cut and dry. They make their money from their general account. And so they pass on more earnings to their clients. Okay. All right. So you got that. Life of the Southwest is good. You've also, if you just want something that just never changes, you can go down here and say, all right, well, I want a rate lock in. That just basically says we guarantee our rates will not change, or cap rates, participation, whatever it is. So if you look at that and say, okay, well, see a cap 5%, 7%, 10 years locked in. Well, that's not bad. 7% cap on the S&P, 10 years locked in. So they will never lower that cap. That's pretty nice. Okay. If you look at the highest cap, it's 8.25. That's 7 years locked in with Global Atlantic. Pretty good. Okay. That's with no fee. Let's see. They do have options for other rider fees if you want to pay those. And sometimes riders, but if you're just looking for growth, you don't need it. So you look at this one, as of the recording of this video, this is the best one as far as highest cap, locked in for 7 years. They're not going to change it. They're not going to lower it or raise it. Okay. So it's much more predictable as far as your growth, but you're not going to be able to take advantage of higher rates like National Life Group will give you 11 to 14%. That's pretty nice. That really makes a big difference when you're looking at long-term growth. So another thing to think about is index locks. Index lock is actually, it allows you to be able to lock in growth anytime between the point to the point. So if, let's say 6 months, you have a ton of growth and you just want to lock it in, you can do that. And you notice Delaware Life is offering that with the S&P 500. Okay, there are other index locks offered by other companies for different indexes, just not the S&P 500. And for good reason. S&P 500 is volatile. The options are expensive. And so there's only a few companies who are actually willing to do that. Okay. So anyways, but I do like Delaware Life's great. And they've got a great renewal rate. All right. So that's it for indexed annuities. I'm going to quickly cover MYGAs. Okay. Because MYGAs, they give you guaranteed growth. Okay. And they also protect you 100% against market risk. So there is no risk. So you can maximize your gains. You can maximize your savings. And a lot of people, instead of doing CDs, they will put their money into MYGAs, multi-year guaranteed annuities. They're basically the annuities world's version of a CD. Okay. And in my opinion, they're better because they pay more. And with non-qualified money, it's tax deferred. So, all right, so let's dive into those. We'll go straight over and I'm gonna pull up top MYGAs. Okay. I want to see the top ones. There's hundreds of them. So you can see for 2 years, and these are the top three. Okay. They're paying, the top one is 5.2 for 2 years. And then for 3 years, it's 5.35. For 4 years, it's 5.25 and so on. You can see 5 years, 5.55. So it goes a little bit higher. 5.5 for the 6 year, 7 years, 5.55, 8 years, 5.15, 9 years, 5.25 with Liberty Bankers, and then 10 years is 5.25. You could do a 20-year option too, but it's a step rate. So it starts out smaller, goes higher and higher, and it's simple interest. It's not compounded. Okay. So if you're okay with locking the money away for much longer periods of time, then you can see the guaranteed ending value after 20 years is $213,000. I probably wouldn't recommend that. I'd probably look at one of these from 1 to 10 years. But you can see just a high savings rate. Okay. You want to lock in a high savings rate. And again, this is for the state of Vermont. Okay. What if some states offer other rates? Most of them are the same. But there are a few states that will actually give you higher rates because that company's only in that state. Let's see if that's any different so for 10 years. See, Ocean View with Vermont, Ocean View was not offering 5.5 for the 10 years. So it does depend on the state, but most of the time they are all very, very similar. But you can see with a different state, you have access to maybe a different contract. Okay. And your savings rate is a little bit higher. So it just depends. Most of the time you're fine. Most of the time it's very, very similar. All the states mostly will sell the exact same products. There's just a few variations depending on the state. New York, they have very low rates of return versus what you can get outside of them. And then as you can see, I switched this to Georgia. Georgia actually gives us a few options with some companies that other states won't give you. So it just depends, but most of the time you can get the same rate. But this is what you do. If you're looking for guarantees, absolutes, okay, this is great. You can throw it in, have a savings rate of 5.5 and that's compounded every single year for 10 years. You know what your guaranteed ending value is. It is $171,000 no matter what, okay? The downside is if you have a really stellar next 10 years of the S&P 500, you're going to miss out on all of that extra growth you could have gotten. Okay, so I like both of these options. One of them is absolute. One of them is hypothetical based off of market returns, and it gives you growth and more growth. So both of them, though, protect you. Both of them minimize your risk, okay? And that's what you're looking for. So if you're looking for income products, we can talk about that. I sell everything. Okay, I sell annuities that provide guaranteed lifetime income, and the rates are very, very high. But those are not for legacy. They're not for growth. Okay, they're for income, and they're great. They're great for pensions. So if you're looking to purchase an annuity and you're looking for someone who you can trust, who will show you everything, regardless of what his commission is. Okay, doesn't matter to me. Some of these, I'll just tell you right now, Ocean View does not pay me as much commission as Heartland. Heartland pays me more. Okay, in fact, I want to say it's double. So it just depends on what you want. Okay, some of these pay me less, some of these pay me more. But for me, as a fiduciary, I have to show you everything that's available. Okay, that's what I have to do as a financial fiduciary. And if you are looking to work with someone that will show you everything, and you're looking to purchase an annuity, please book a call. There's a link below this video. It goes directly to my calendar. Go to my website, johnstevenson.com. You'll be able to see, if you want to go to the MYGA rates, you'll see those. If you want to actually look at fixed index annuity rates, you won't see those, but you'll get an opportunity to book a call because you can see it's complex and it's so different for everyone. That's why I only have a book a call feature in there for that. So anyways, I'm happy to help. Whatever you're looking for, if you're looking for guaranteed income, if you're looking for absolute growth from a MYGA versus hypothetical growth from a fixed index annuity, there are options for everything. Okay. And if you need someone who knows the market, who can guide you through all of those, that's me. All right. So I hope this video helped. If it did, make sure you like, subscribe, share, comment below. Book a call if you're looking to purchase an annuity. I'm not going to try to hard sell you on anything, but I will be there to answer your questions. And of course, I'd love to earn your business if that's something that works out for you. So again, thanks for watching, and we'll see you next time.